In my video last week, I made this prediction. This is a tough call. I mean, if I were just looking at this increasing risk confidence and falling bottom confirmation, I would say we could see a softening next week and possibly go lower. I'm kind of a little bit reticent to call that, though, because the market was moving higher over the past couple of days. And you can see how the market softened here on Monday and into Tuesday. Now, you can see that better if I remove ARK from the picture, because ARK moves a lot and it makes these others look really tight. But you can really see that here, how all the indices dropped right out of the gate on Monday after the market opened. They kind of rallied back and then dropped again on Tuesday, and then started to go up at the end of Tuesday, and then continued higher from there. So when I make these predictions of future market moves, they're only good for a few days at best. I'm definitely not trying to predict how the market will do over the coming week or the coming month, although many times it works out that way. So take these predictions of mine with a little bit of a grain of salt here, but they tend to be correct over the short term. Let's have a listen to what Tom Lee had to say on CNBC almost 2 weeks ago.
When you came on last call last time, you made an interesting prediction. I want to play that. Here it is.
I think it's possible that we make a minor new high before the end of the month, and then we might have something like a 7% drawdown.
Since then, the Dow and S&P 500 have hit record highs. I mean, I think we're on track now for 5 days of new records. Are you still predicting a pullback, and what would be the catalyst there?
Well, as that clip said, we expected new highs by late January, which was on schedule. And I think this week is going to tell us how much further we go. You know, we were sort of penciling in 5,000, and we could maybe go higher. But from there, yeah, I think an air pocket forms because, one, as you sort of point out, investors will get nervous about the Fed, and when they start tightening, and parabolic moves, which we've had since October of 2023, usually end in a pretty big retracement. So I do think.
So wait a minute. So why would Tom Lee say the markets are likely to drop 7%? And what should you do about it if you think he's correct? So to understand a little bit about where his thought process might be coming from, I did an analysis of the S&P 500. You can see I'm going back to January of 1988 here. And if we look at the S&P over that time period, it had a compound annual rate of return of about 11%. And if you look at the daily returns, that works out to be about 0.05% per day, but that's kind of meaningless here. And look at the time frame. We're talking about 36 years. That's a very long time. Now, if we go back to January 1st of 2022, when the market was kind of at its peak, and look at where we've come since then, we're only at an annualized rate of about 4% per year, and a very small daily percent change. And that's over the past little over 2 years. Let's go back to the bottom after that peak in January of 2022. And you can see that the market is up about a 31% per year rate. And again, 0.11% per daily change. Now, let's go to January of 2023, and we're up about 29% since then on an annualized rate, and again, 0.11%. But what Tom Lee is saying is that since the recent bottom on October 27th of 2023, the market is up about 23% since then. Now, that's only a little less than a third of a year. So if you annualize that, the market's up it's running up 103% per year at an annualized rate. That's huge. And if you look at the daily change, it's also huge. It's more than double this 0.11% that we'd been seeing. So if I take Tom Lee's prediction and say, okay, let's say the market falls 7% by May of this year. Now, if I do that, that pulls the annualized rate of return back into the, this 29% range, and it pulls the average daily percent change back into this 0.11% range. So that seems reasonable. But I want to caution you about these kinds of predictions by people on CNBC. So you can see what's happened here. Here's some of the numbers we were just talking about. So the market peaked out here right around January of 2022. We had a pretty good pullback in here into October of 2022. And then things started to take off. And then we had a recent pullback here in October, the end of October 2023. So Tom's basically saying we've got this parabolic move. You can see it. The market's it's a very short line, but you can see this is shooting up very rapidly. Well, is that necessarily bad? Well, let's take a look at some other things. Well, if we go back to the pandemic, again, that was a highly unusual situation. The market actually shot straight up. You can't even see a slope here. It shot straight up and then moderated some more before the Fed started raising rates and things started pulling back. What about back here, 2007 to 2009? Again, straight up off the bottom, and then it started to moderate. And it was quite a while, by the way, before we got some pullbacks here. So, I'm leery of making predictions that we're going to pull back 7%. Now, he could very well be right, but I think that's a ballsy prediction. And look at back here in 2002, 2003. Again, when markets come off of these bottoms after a lot of downward move, you can see what happens. They tend to shoot up very rapidly, and then their rate of return moderates. So it really doesn't give me that much concern that the market's shooting up now. Now, if it pulls back 7%, it pulls back 7%. Look, CNBC caters to traders who try to make short-term moves to take advantage of volatility in the equity markets. Over the long term, and I mean 10 years or more, as you can see in this chart, it pays to be an investor instead of a trader who tries to time the market movements. At the end of this video, I'll refer to 2 of my videos that describe how to create the ideal portfolio for the long term. With all that, let's take a look at how the equity, bond, gold, and crypto markets are looking right now.
I'm afraid to say how I feel.
So as you can see, and we looked at this chart before, over the past 5 days, over the past week, we have a very, very healthy appetite for risk here. ARK Invest, the riskiest basket of stocks, is up the most, up very nice, up 7.34% for the week. Small caps are up second, NASDAQ third, S&P fourth, and Dow fifth. This is exactly what you want to see. I'll take the NASDAQ beating the small caps, which will happen off and on, but this is a very healthy risk appetite here. And what if we look over the past month? Well, you can see that ARK really kind of struggled over the past month, but since February 5th, it's been really shooting higher here. And the NASDAQ's leading the way over the past month, followed by the S&P. The Dow and small caps are neck and neck. But the small caps really kind of pulled back here. Investors started selling them back here, which may or may not have been a good idea. But anyway, you can see what's happening here. We have a pretty healthy risk appetite going on right now. And what if we look back over the past year? Well, wow, a very healthy rally here with the NASDAQ 100 up 45.83% over the past year. And this is a very, very healthy looking rally. You can see ARK has been much more volatile, as you would expect, but you can see it's shooting straight up at a rapid pace here, followed by the S&P, followed by the Dow, followed by small caps.
Don't wanna let you down.
Let's take a look at the bottom dynamics, because these are very telling in terms of what's going to happen in the short term. So last week we had a falling equity confidence level, we had a rising bottom confirmation, rising prices, and a falling bottom forming indicator. What that told me was that the market was likely to soften. And in fact, that's what happened here. It softened a little bit and then continued higher. Now where are we? Well, if we take a look at this, market's moving higher for sure, but the bottom confirmation is falling. And the bottom forming indicator is going up as the risk confidence level is going up. This tells me we could be in for another softening. So let's see what happens. But that's not totally supported by these metrics. Now, what are we seeing here? Now, risk acceleration is certainly moving higher. That supports the thesis that that the equity markets could soften. Risk started to move a little bit higher. But look, these levels are so low, they're not at a level where I'd be concerned, but you don't like to see them going up. That's not a good sign. Now, the opportunity level is also going up. So that's kind of contrarian here. So this looks good. This could look not good if it keeps going that way. And this you don't want to see going higher. So these don't fully support the market softening next week. But I tend to go with the bottom dynamics because they tend to be very telling. So let's see where that goes. And what about equity versus safety? Well, we have come a long way, baby. You can see that equities, in fact, let's just flip ahead and look at how these things have mapped out here. You can see that the NASDAQ 100 has stayed firmly in first place, followed by the S&P 500, followed by the Dow. And the small caps, which were really down here at the bottom, have done a nice job coming up. So you have 1, 2, 3, 4, the top 4 positions for equities. This could not look better except to have small caps up here in the number 2 position, but they are moving higher. So this is great. I also like the fact that cash is moving lower. So this looks great. Now let's take a look at the risk appetite for treasuries. And what you're going to see here is kind of interesting. It looks a little wonky like a bowl of spaghetti, but you can see from before that cash has dropped, which is good. What's also interesting is intermediate bonds, IEI, have gone from up here all the way to last place. And by the way, EDV, the riskiest, longest duration treasuries, have moved up above TLT and now are above intermediate 20-year bonds. And they're above both of those. So this is great. This is moving in the right direction. Now, it's interesting that 1 to 3 year treasuries actually moved up a notch here. So not quite sure what to make of that, but this is starting to look much healthier. You can see back here that EDV was below TLT. It was below TLT here, below TLT here, below TLT here. And back here, when things were a lot healthier, it was above TLT. So I like the way this is starting to look. This really is starting to look good. And what about buying and selling pressure? Well, nothing to fear here, clearly. And we've had a very nice rally in the Dow. You can see that the buying pressure has been kind of declining since back here a little bit. And the selling pressure kind of has been coming up, but not much. But I like the fact that the buying pressure, this solid gray line, is above the selling pressure. That's good. S&P 500, again, very nice rally. Buying pressure well above the selling pressure, although declining a little bit on Friday. If we look at the NASDAQ 100, we had a very nice, healthy buying pressure back here. You can see how nicely this was well above the selling pressure. And then they kind of intermingled here, and the buying pressure, again, is above the selling pressure. And then ARK Invest really struggled. You can see that here. When the NASDAQ was doing well, ARK was declining. You can see the selling pressure was above the buying pressure. And now they've been kind of noodling here, although the buying pressure is currently above the selling pressure and the price is shooting higher. So hopefully this will continue. What about small caps? Well, you can see that small caps really got hammered here. They kind of rallied, they pulled back, now they're going up again. So really a rough ride here. But you can see over this time period, the selling pressure, this solid orange line, has been declining, while the buying pressure, the solid gray line, started increasing back here as these were still falling. So that kind of divergence is really good. Now, where are we now? Well, where are we now? The selling pressure, this orange line, is starting to increase, and the buying pressure is decreasing as the price goes up. So that's another divergence. That could mean that these are going to pull back in the short term. Now let's take a look at sector rankings. These, remember, they react very slowly. So this is kind of telling you where things were at, not where they're they are or where they're going. But you can see that a week ago, we had a very healthy looking risk appetite. Bitcoin up at the top, semiconductors here, ARK Innovation, technology, emerging companies, small caps, IWM. You can see that Treasury market looked healthy even though it wasn't. Again, these move slowly. And consumer discretionary above staples, cash way down here. Well, if we fast forward to this week, you can see cash is still down here. You can see that treasuries are still in a healthy relationship. Consumer discretionary moved up a notch. And you can see that Bitcoin and semiconductors and ARK are still all up here. Technology, small caps move back a bit. But this, again, looks very, very healthy. So let's now look at sector rank acceleration, which gives you a little bit more of an idea where things are or where they might be headed. And you can see last week, now you can look at treasuries and say, wow, 20-year treasuries were way down here. This is a very unhealthy looking treasury market. Consumer discretionary way down here. That shows an unhealthy risk appetite for equities. And we had ARK at the bottom. Again, very unhealthy. Now, contrary to that, we had the NASDAQ 100 up here. We had semiconductors here. And small caps were kind of here in the middle. Let's go to this week. So if we go this week, it looks like 20-year treasuries have slipped down a bit. Now, that doesn't mean that they slipped down. It means that something else displaced them, possibly. But if you look, what's interesting here is intermediate treasuries are now ranked lower than longer duration 7 to 10-year treasuries. So this is starting to look like a more healthy treasury market. And what bothers me is that cash in this view has moved from down here to up here. But consumer discretionary has also moved from down here to up here. Now let's look up here and see what we're looking at. Well, we've got semiconductors here, NASDAQ 100 here. So that's moved up nicely. Where is ARK Innovation? ARK Innovation has gone from last place last week. It's moved up several places here. That's healthy looking. So kind of a mixed bag here, but sort of moving in the right direction. And what about treasuries? So if we take a look at treasuries, you can see that over the past week, they tried to rally here and then kind of fell off on Thursday and Friday. Not a healthy treasury risk appetite if we look back over the past week. If we look back over the past month, again, a struggle. Pullback, nice rally, another pullback. And then if we look back over the past year, you can see, what happened. They absolutely got wrecked as the Fed raised rates. The huge rally here, a pullback, a nice rally again, and then another pullback. I think personally, as the Fed lowers rates this coming year, these long treasuries are going to be the place to be. They should benefit from that. And how does that show up in the buying and selling pressure? Well, not a great picture here across the board. You can see the short duration treasuries, 1 to 3 year, the selling pressure is shooting up and the buying pressure is collapsing as the price comes down. What about intermediates? Same picture, declining price and buying pressure heading higher, but not shooting higher. So these are a little bit better looking. What about 7 to 10 years? Again, declining price, selling pressure shooting straight up. And then if we look at the long bonds, 20-year bonds, price collapsing here, selling pressure shooting straight up. So not a good look for treasuries right now. So what about that inverted yield curve? Well, let's take a look. So if we take a look at the inverted yield curve, interest rates have gone up since last month. Now, this light blue line is a year ago. You can see that long rates were a lot lower, but actually shorter rates were higher than they are now by a little bit. And the dark blue line is where we are now. You can see that rates are higher across the board than they were 1 month ago, this red line. And what about the how inverted are we here? Let's take a look. So we're about 31 basis points inverted. So that's kind of in line with where we've been trending. So let's take a look at the Fed rate monitoring tool. Well, if we take a look at the Fed rate monitoring tool, it's 5 weeks until their next Fed rate decision. And the market thinks it's highly likely that the Fed's going to leave rates right where they are. 84% chance rates stay unchanged. That's what that blue line is. Now, if we go out to May, you can see that drops by more than half, down to 39%. And there's a more likely scenario where the Fed lowers rates by 0.25%. What if we go out to June? Now you can see that it's very unlikely that the Fed will leave rates where they are. More likely they drop by 0.25% to 0.5%. If we go out to July, it's almost a given they'll drop by 0.5%, and some likelihood they'll drop by 0.75%. So the markets think the Fed's going to lower, and I think the Fed should lower this year, or else they're going to get really behind the curve.
Feel like I'm afraid.
And what about gold? Well, yeah, those gold diggers, they're not doing much here. This thing rallied, pulled back, it's been kind of going sideways. And what I really don't like here is this huge spike in the selling pressure right here in the last day of last week. And you can see the decline in price here. So right now, this does not look good for gold unless bottom feeders start to jump in here and start buying.
You can have it.
And how about Bitcoin? Well, Bitcoin has been an interesting place. You can see how the buying pressure went almost off the chart here when those 11 ETFs were approved by the SEC. And then, of course, common wisdom, sell on the news, which they did. Now, I wonder if they were smart enough to buy here after they sold, because Bitcoin and cryptos in general have been going higher. And you can see that in the buying pressure, which bottomed out here and has been trending higher since. So these look really, really good.
If it's only you have.
Personally, I find CNBC to be a really good source of entertainment, and sometimes it's very informative. But be very careful about the advice you'll hear offered by its guests, especially if you're a new investor. Investments and investing aren't that complicated if you know how to allocate your portfolio without destroying your returns and getting little to no protection from downside risks. As an investor, you need to take the long view and allocate according to your risk tolerance, rather than fretting about what's currently happening in the world or what everybody else is doing that you read about in the media with their portfolios. If you want to be a better investor, I discuss how to allocate your portfolios in 2 key videos linked in the pinned comments below, titled The Ideal Portfolio Using Just 2 ETFs or Mutual Funds, and The Ideal Portfolio Using Individual Equities. Again, link in the pinned comments.
If it's only you have. Of your mind.
Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.
Stay up all night, gotta work now. Make up my mind, then it turns around. Say that I'm fine till I burn out. Thinking this money sounded so nice. Ambush here in the strobe lights. Pay anything for the high price. This life feels like the sunny water. Wet my lips, but the sun's stronger. Pour it out, if I'm being honest. It's just not everything you promised. Running out, drying out, what did you say? What did you say when I told you? Maybe this wrist wasn't gold-proof. Packing my bags like it's all true. Hard to make friends when I'm focused on all these bars that I'm holding. I like the cold, but it's lonely, yeah. This life feels like the sunny water.